Hi, this is Mark Maiewski. And for the best tax planning strategies for small business owners that you won't find on Main Street, make sure you subscribe to my channel and hit the bell to be notified when I post a new video. Are you serious about accelerating your retirement plans by twice, 3 times, or maybe even 4 times what you currently contribute? Well, by the end of this video, you're going to know whether a cash balance plan could be a good fit or a bad fit for your company. Let's jump into the advantages first. First, funds contributed to a cash balance plan are tax deductible and the earnings grow tax deferred. This is going to have a dramatic effect on the amount of money that you can accumulate for retirement. Second of all, any money accumulated within a cash balance plan can be rolled over whether you leave employment or you finally retire. And you won't have to take any distributions on those until age 72, which just changed this year. It used to be 70 and a half. And you'll be very minimally taxed at that time. Next, contributions to cash balance plans provide the same deduction as any other deduction, dollar for dollar, from your income. So with contribution limits as high as $100,000 up to even $275,000 depending on your age, this can have a dramatic effect on the amount of tax savings that you have. And we see some business owners saving as much as $100,000 a year on their personal income tax return. For example, a single contribution of $130,000 compounded at 5% over 30 years would result in over $561,000. Okay? If you took that same $130,000 and took the tax out and then took the tax out on the growth each year, okay, at the end of that same 30-year period, you'd only have about $293,000, which is about 52% of the other amount. So let me ask you, which one would you rather have? The full 561 with minimal taxes taken out, or the 293? See, contributions to cash balance plans are counted as above the line deductions or adjustments to income. Now these are the most coveted tax savings, because what it allows you to do is this occurs before you calculate your income tax bracket. So any of these deductions show up, which help lower your adjusted gross income. These deductions are particularly beneficial for high income earners because they've lost these deductions. Now, if we can move them through the use of a plan into a lower tax bracket, not only have you saved money on taxes, but now you may qualify for deductions that you lost long ago with a higher income. So remember, 2 things. You can save money by lowering taxes and at the same time maybe qualify for deductions that you haven't seen in a while. Here's another one. After staff costs, taxes are normally a small business's second biggest expenditure. Well, if now you can deduct a significant amount for employee contributions plus put aside a generous amount of tax-deferred retirement contributions for yourself on top of your other plan, now you're really in the driver's seat. Like all qualified plans, cash balance plans require contributions for non-employer employees, which becomes a key benefit for these employees. Think about this. Now all of a sudden you have taken and you've started to attract, reward, and retain top talent with additional benefit that may not have been there initially. This helps you stand out in a crowd of employers for those who are looking for a great, not only place to work, but a great way to save money. So this is why it's really, really special for professional service firms, because not only can you be rewarded at the partner level, but you can also be rewarded at the employee level. Assets in a cash balance plan are protected from creditors in the event of a bankruptcy or lawsuit. In volatile economic times, preserving profits is crucial for any business, especially through taxes and protection from creditors. Because investments are usually tied to a conservative benchmark, cash balance plans have avoided the major fluctuations that we've seen in 401k accounts over the past few years. While 401k account holders rely on higher risk strategies to maximize growth, cash balance plans rely on higher contribution amounts at rates that continue to beat inflation without taking on major risk. After this video, check out the video I created titled Biggest Retirement Mistakes Business Owners Make to see if your company is on track. And the link is in the description below. Okay, let's jump into the disadvantages. Well, there's always a cost to everything, okay? And with the cash balance plans, the funds have to be insured by the Pension Benefit Guarantee Association. Okay, this is in addition to the setup fees. Okay, the normal setup fees for this run between $2,000 to $5,000, and the administration fees run from $2,000 to $10,000 a year. Okay, in addition to that, there's also an administrative cost of about 1/4 to 1% each year. It's possible that these costs will potentially lower the return, yet the tax savings will significantly outweigh these costs. Hey, here's another thing that sometimes affects people. Directions of funds is done by the employer. Now, we've all had to set money aside in a 401k or an IRA, and then we have to pick which fund do we want to put this in? How do we break up our money? We want to pick something aggressive. Do we want to pick up something moderate? Do we want to do it conservatively? Okay. Well, in a cash balance plan, this is all done by the professionally managed firm. There's no choices in regard to how it's done. It's done the same for everybody in the group. And another item to consider is that not only are you setting up an account for yourself as an employer or a partner, but you will also have to contribute for employees as well. Okay, generally about 5 to 8% of their salary. And if saving hundreds of thousands of dollars a year additionally towards retirement, as well as slashing your taxes significantly, is really important to you, then click on the link below to see if you qualify to work with my team of tax professionals, CPAs, tax and pension attorneys, chartered financial consultants. We have a full team. We'd love to be able to speak with you. I'm here to help you minimize your taxes through strategies that you won't find on Main Street.